Hey everyone, and welcome to another episode of What's Up. I'm Zach, this is Angela, and last we left you off, we were talking about preparing for tax season with Kathy and I. Well, I'm happy to say we're through that season, and we just want to start off by saying thank you. We made it through another tax season, and today's episode, we're going to be talking about shifting gears, and specifically shifting from tax preparation to tax strategy. We got a couple things to cover here today, Angela, but do you want to start off and set us up for today's conversation?
Sure. I think the weather in Calgary is like the government, or the government is like Calgary weather, volatile. We've got some budget changes to talk about, and we are going to make this very timely and relevant to our listeners.
You betcha.
Yeah. So, just before we kick it off, can you just quickly go over difference between tax preparation and tax strategy?
You got it. So I like to think of it in its simplest terms as tax preparation being a look to the past, whereas tax strategy, what we're moving into now, is taking a look at the present state and shifting our focus to the future from a planning perspective. So we've done our we've filed our taxes. A lot of the strategies from our conversations last year would be reflected in our tax returns, whether we're saving for retirement or our retirees. Now we switch. We've had our recent campaign to ask for your notices of assessment. We've been very diligent on that, and that's a big part of one piece of what we touch base with you on our conversations this year. What's changed in your life, changes to your income, your spending, those kind of pieces really influence the strategies we develop from specifically tax, what we're talking about today, when we're looking forward to things. So that would be the major difference in those areas. We'll have our conversations and address that at your upcoming meetings throughout the rest of the year to put in place those strategies and have those conversations. The last piece that kind of goes into tax strategy is a good little transition into what we're going to be covering, and what's on people's minds this year is what happened on April 16th, which is Budget 2024. And so before I pass it over to Angela, just a reminder, we had sent out an email in mid-April to all of you fine people with the federal budget. It just had a lot of the highlights in detail of what came out of that budget. So I just refer you back to that document for a few of the things if you want to get into a little bit more of the nuance related to some of the budget changes or proposed changes. And we're going to focus at a high level of what you need to know and some specific things related to the budget for today's VCast.
One thing that I wanted to point out before we get into the capital gains stuff is about housing affordability was increased in terms of increasing the rate that you can draw from your home buyer's plan from
Right.
35 to 60,000, and if you use that in conjunction with your first home savings account, you can put down or save even more for that first home. So as you mentioned, the budget came out in April, and it was about the capital gains changes. And why is the public so fussed about this?
That's a good question, Angela. And the easiest way to sum that up is, again, we've got a proposal from the government to increase the capital gains inclusion rate, which we'll get into a little bit more, but the big fuss was the timeline. And so the action that needs to be taken ends, and the new inclusion rate increases effective June 25th of this year. So it really, I think a lot of the itchiness of people was related to that short timeline in order to take action. So that was essentially some of the feedback that we've seen from people.
Yeah, I was reading about the history of the capital gains tax rates, and in the 70s it was introduced. In 1988 it went from 50% to 2/3. It went even further up in 1990 to 75%, and that lasted about a decade. And then in 2000, since 2000, we're back down to 50%. So where are we at now? Or what is the proposal?
We're going in the other direction now. So what the government's proposed is an increase from 50% of capital gains being included in your taxable income to roughly 2/3 or 67%. So a higher inclusion rate on the realization of capital gains. And what they've done that's different than in previous legislations specifically for individuals is that increased rate doesn't apply unless you're realizing capital gains over 250,000, which will be the threshold. So really their justification for that is that they're really only targeting that 1% of wealth, but it can impact people, and we'll get a little bit more into that.
Mm-hmm. So just to go over quickly what a capital gains is, it's the difference between what you bought something at and what you sold it at. So the cost base and the selling price is that capital gain. And when Zach was saying unrealized gain is if you don't sell it, whether it's property or investment, then it's unrealized capital gain.
You got it. And that's let's take just a minute to reflect. A lot of that appreciation, or those who do have unrealized capital gains in the people we work with, that's been a product of some deferred growth. So there is some positive nature to holding unrealized capital gains, but we're here now and we do need to, is there something we need to do? And that's what we'll focus on here. First, I think it's important to say who this doesn't affect, or those accounts where we don't need to worry about this. And that's your registered investment savings accounts. So your RRSPs, your RIFs, your LIF accounts, your TFSAs or tax-free savings accounts, RESPs, and registered disability savings plans, or RDSPs. So those registered accounts aren't impacted by these new changes. And so which accounts are impacted, Angela?
The non-registered account, the corporate accounts, trust accounts, and real estate other than your principal residence. So you have the PRE, which is the principal residence exemption for that property. So the new inclusion rate is, as you mentioned, if you're over 250,000 in capital gains for individuals, you'll be taxed 2/3. So that means within a 1-year time frame, right?
Yeah, that resets every year. So you've got that $250,000 threshold where you can realize capital gains at the previous 50% threshold before you're actually subject to the new 2/3. So that is, a benefit for most people where we're not realizing $250,000 in gains every year. We don't have to make any subtle changes in that regard, but there is some points of awareness for those, even if we're not transacting every year. Maybe give us some insights into, for those non-registered account holders, what we need to be aware of for those gains maybe later down the line.
So for the majority of people, there's no need for action, but for maybe aging clients or people who are looking at estate settlement options, then there could be some considerations to be made.
Yeah, and I think one of what you're framing up there, and maybe give us some insights. There's a bit of math behind that, because essentially, if we were to think about triggering some capital gains in the short term here, the first thing we've got to consider is the prepayment of tax. That is something where we're going to have to pay tax up front, even though it's at the 50% inclusion rate. There's a bit of a break even we need to maybe understand. Do you want to touch on where the benefits, perhaps the benefits of keeping that money invested or not triggering gains now, reactionary to June 25th, perhaps outweighs in the long run the savings of having some of your gains later subject to that higher inclusion rate?
So we did some calculations, and it turns out that the break-even time period is about 6 years.
Yep.
For maybe if there is that time frame, and we always look at the long term anyway, then we don't necessarily have to take action right before June 25th. So that calms a lot of nerves, reduces stress, hopefully, because we have the long-term view and the overall picture in mind as planning team.
Good points. So that's our non-registered investment holders. The other category that we want to speak to today is those who have corporate investment accounts. So investments held within a corporate investment account don't get the benefit of that $250,000 threshold.
Yeah.
So any realized capital gains on a go-forward basis after June 25th for those corporate investment accounts will be subject to that 67% inclusion rate. So Where we're seeing potential we're starting to have conversations with your other professional teams like your accountants for those who do have those corporate accounts to see if it makes sense to do some realization of gains prior to June 25th. And we'll be in touch should that be a strategy or at least an option we want to consider for those of you with the corporate accounts. Know that we'll be in touch in that regard. Just to make sure we're doing our due diligence, there is still some mechanics there, and we want to make sure we're doing a thorough evaluation before we're suggesting, again, prepaying that tax right now. Is it worthwhile in the long run? So we'll be in touch regarding that side of things. Trust is another issue that was brought up by a lot of our peers as is there opportunities here? For most trusts or the few people who hold investments within a trust, because usually trusts and the way they're designed is that you distribute the income each year. Without getting too much into it, the beneficiaries of those trusts will have that $250,000 threshold at the old capital gains rate. So perhaps not as much need to investigate those at this point in time.
And one thing also I wanted to point out was capital gains are still the preferred rate, still lower than interest rates, net rental income, and dividend tax rates. So
You got it. Yeah.
So hopefully what we've talked about today has clarified and just all that. There's a lot of media attention around this, and we will be reaching out and having conversations with you throughout the year, but there's no need to panic before June 25th.
Perfect. And I guess we'll then take the time to set up what we have down the pipeline as far as our next WhatsApp episodes. And I'm looking forward to Peter, Elise, and Thomas are going to give us some more market insights as our next episode of WhatsApp. And down the line, Peter and I are going to actually speak to an interesting product for those of you who hold single security investments or a single stock, and just some options around that from a tax planning perspective, paired with the opportunities for diversification. So just some knowledge in that basis of some of the strategies we're looking at in future WhatsApp.
Looking forward to that. Yeah.
Perfect. So for today's episode of What's Up, I'm Zach. This is Angela.
See you later.
Happy spring. Happy summer.